have three of our panelists, and one is yet to come, but I'll introduce those. Hi. I will go in backwards order and start with Roger Lee, who, interestingly enough, recently invested in Gainsight, so I'm starting a little bit backwards. He joined Better in 2001, investing in software and internet and digital media, and he was actually in industry before, having co-founded Choreo and NetMarket, and also invested in Angie's List, another customer who was here and talking earlier, as well as Groupon. And then we'll talk about Ping Li, who's been at Excel since 2004, where he focuses on software and digital media. And he's also responsible for their big data fund, which is obviously...
Here's our fourth.
Oh, there's our fourth. Yay. Okay. So shake the little rattle thing. Yay. Okay. So thank you for that. And the interesting thing also about Ping is that he's a board member of Cloudera and Relate IQ, which relate to the big data fund, and he has over 2 decades of experience. So it reminds me sort of mine with roughly 3 decades. So it's nice to have other experienced people here on this panel as well. And before he worked for Juniper Networks, McKinsey, and Goldman Sachs in Asia. And turning to Byron, oh, there we go, Byron. Byron had one of the most interesting bios where it talked about how he met his future wife within 15 minutes of being on a college campus. So there must be a record for that.
That's the highlight. It's downhill from there, I assure you.
Exactly. He joined Bessemer, which certainly was another highlight, in 2005, where he looks at cloud computing and internet. And he worked for IBM before because it bought a company that he had co-founded. And he actually also invested in Cornerstone On Demand, a company that I was involved with the IPO of. I've done 18 SaaS IPOs, so I'm surprised I haven't done more with some of the other people on the panel here, but he also invests in Eloqua, another name that's come up a lot today, as well as Intact. And finally, but last but not least, RF Hilali joined Sequoia just last year. And he also focuses on enterprise, internet, and mobile, and was formerly the CEO of Clearwell Systems, which was acquired by Symantec. And before that, he was founder and CEO of CenterRun, which was acquired by Sun Microsystems. Now that I've got those quick bios underway, I thought I would start with maybe each person of the panel talking maybe for a minute or so about their high-level thoughts on renewal rates or the reverse of that, attrition. So why don't we start? We'll do the last in, first out. So we'll do the LIFO method of going through the panel. Go ahead, Art.
Sure. Good afternoon, everyone. Sorry, I had it down for a slightly later time, which is why I arrived a minute late. I mean, when Nick asked me to speak at the conference, I was thrilled to do so because I think this is really one of the most important issues facing a SaaS company, certainly across our portfolio. Over the years at Sequoia, we've had the privilege of being the first investor and business partner to several spectacular SaaS companies like LinkedIn and Google and Jive and ServiceNow, and as well as working with emerging companies like HubSpot and Hearsay Social and Sky High Networks. And from that experience, we found that really this is the critical issue that determines the trajectory of a company. When we think of it, people often talk about churn rates. We don't see churn as being the relevant term for an enterprise company. We see it as being more for a consumer or small business type companies. In the enterprise, we think really of dollar retention rate as being the critical thing, meaning for a given cohort of customers, how many dollars do you make in the current quarter relative to the amount you made from them in the quarter in which they signed up, and that should be at least 100%. For some of our best SaaS companies like ServiceNow, it's more like 125%, and is the cornerstone of a successful business. To some extent, it's a trailing metric. The current metric is really around usage of the product, and the forward-looking metric is how much people love the product. But in the early years of a SaaS company, the financials often don't make any sense. I mean, Workday had negative gross margins up until they passed 25 million in revenue, and so if you're looking for a financial metric, that's the one that we look at most closely.
And that's sort of, we're going to talk a little bit, you're sort of stealing the thunder for 3 questions from now, so you're, as many venture capitalists do, running ahead with where the market's going. But let's quickly talk with Roger and just give me a quick thought on renewal rates, retention.
Yeah. So I would echo a lot of what Arif said. we focus a great deal in our diligence process on renewals and churn rates. And just to put the importance of it in context for the audience, if you think about two SaaS companies, both of whom have $20 million of recurring revenue, both of whom are growing at 50% per year, one of those companies has a churn rate of 5% per year, and the other one has a churn rate of 15% per year. Fast forward 5 years later, the company with 5% churn has 90 million of revenue. The company with 15% churn has 60 million of revenue. And so the compounding impact of that churn, the SuccessFactors CFO was just talking about this, the compounding impact of that churn over time is incredibly important. And so in this scenario, you've got two companies that look and smell identical, but the churn impacts them by a scale of 50%, 90 million of revenue versus 60 million of revenue 5 years later. You then look at what those companies will trade at in the public markets, and you multiply that revenue base by a factor of 5, which is a standard SaaS multiple, and the difference in valuation is roughly $150 million. All driven by that 10% delta in churn. And so if you guys are thinking about how do I justify this to my CFOs and how do I make an argument for the actual economic impact, just walk through that very simple math and you will not have many problems, I don't think, with your CFOs. I think they would agree that you could drive a lot of impact as a result.
And what about you, Ping? What have you?
Yeah, I mean, I think lots been said. At Excel, we look at actually churn and retention probably as important as growth, because I think another way to say, Roger, that is actually one of the growth factors. A lot of people don't focus on that. They just look at the top line growth. They don't realize that if you fast forward, that is actually one of the limiters of growth and potentially causes the treadmill effect that we see a lot of companies kind of top out. They hit a certain growth rate, then the retention kicks in, growth rate slows down, then they're on this treadmill and they keep burning cash, they can never get out ahead of themselves, right? So for us, retention rate is a real good measure of durability of the business, and that's kind of something that we look for in everything we invest in is, can it be big over time, not just in the period of the investment decision.
Okay. And finally, Bernard?
Yeah, maybe just to double click on some of those thoughts. The public market correlation, I think, shows for every 2% change in churn rates, you get a 20% bump in multiple expansion. And so very tightly correlated and highly quantifiable. I think the qualitative view in the private market and for emerging companies is that it's damn hard to acquire customers. And with the leaky bucket, it's just extremely painful to be losing them out the back end in any meaningful level. And so, as others have said, we absolutely look at it as a leading metric. At Bessemer, we've developed a whole set of cloud laws and metrics that we prioritize in terms of how do we filter value, and it leads us sometimes to come up with different conclusions, but fundamentally, churn is an important one of those. Net negative churn or positive upsells on a dollar basis is absolutely a leading indicator for our early stage investments. And then over time, as Ping just said, as businesses get to scale, if those churn rates are painful, you just hit a wall. The business plateaus because fundamentally, with high rates of loss on the back end, no amount of heroic sales efforts or customer acquisition cost efficiencies can overcome that. And we see that in the public markets, unfortunately, with some businesses very visibly today.
What's interesting, one of the first questions I was going to ask is how important is renewal rate or churn to each of the VCs here? And it seems like they all answered the question in the brief introduction. So I'm going to switch it up a little bit and really try to get a sense of when you have a problem with churn, but what do you do about it? And maybe I'll start, since you were last, I'll start with you first, Byron, and maybe talk about some of the things you can do when you're in the hole with churn.
Sure. I think the first thing is just to understand root cause analysis, and so try to segment churn into buckets. And we like to say death and marriage are acceptable. So if companies that go out of business or get acquired a lot, that's one of the few cases of acceptable churn. And by its nature, if you're selling into SMB businesses, you're going to have higher rates of death and marriage, and so it's highly likely that structurally you need to design in for larger rates of churn. Most other causes of churn aren't acceptable, and as you split those up, they can go into poor account management, product issues. There's a whole list of things, and across our portfolio, different companies tend to have different buckets that make up large chunks of that. But you then run through a process of pretty systematically understanding how can we address those. A lot of it goes to the customer interface and the account management team, and at that maturation point of process there. A lot of it obviously goes into product and sales dynamics, sometimes implementation dynamics, and it takes a pretty thoughtful approach to slice it up so that you can address the issues one at a time and typically there's no magic bullet, but they are solvable problems.
It's interesting, one of the things that Byron just mentioned is that some churn is unavailable in the low end of the market, sees higher churn. Having covered over the years 30 or so public SaaS companies, one of the things I've noticed if you're at the low end of the market, like a Constant Contact, where you're dealing with the S of SMB, dog walkers, pie makers, cheesecake bakers, your churn is pretty much going to be 25 to 30%. Yet if you're at the enterprise, if you're a company like Concurrent Expense Management, you're going to have about 97% plus renewal rates. Roger, did you want to talk a little bit about that as well in terms of some of the things that you can do?
Yeah, I mean,
when you've got
look, I think the first thing is setting an organizational commitment to it and identifying, what are the goals going to be? And so if we look across our best-in-class SaaS companies, at a customer level, the best-in-class churn rates are, call it, 5% or so per year. And on a revenue basis, it's net negative, and it's similar to what Arif was saying, where, it's 110%, 120% per year. And so setting that as a goal, and then from there, really figuring out what can you identify 3 months, 6 months in advance that are the leading indicators of the churned account. The churn event is always the lagging indicator, and there's usually these kind of footprints in the snow that you can find that will tell you that account's high risk. And so as an example, as part of our diligence in Gainsight, we talked to one company that had deployed the product, and we're tracking product usage. Was it increasing or decreasing? And both, on a relative basis, and were they adding, numbers of users? So the people that were using it more or less, and were they adding more or less users over time? How are the NPS scores evolving? Were they paying their bills on time versus how they were paying them in the past? The number of inbound trouble tickets that the company was generating. All that came together to generate a kind of customer health index. And the company that deployed that took their churn rates from 80% to 94% within 12 months. And so by, basically setting a goal and tracking all these leading indicators and getting out in front of these issues before it got too late, they had a meaningful impact on the company.
Maybe following up, did you want to jump in?
Yeah, I would just say, building on something that both Byron and Roger said, if I look across our portfolio, the ones that do it well are the ones that actually are very data-driven. I think that's something, there is no silver bullet, and the ones that are collecting all the metrics, whether it's operational, inside sales metrics, all the way up to product engagement metrics, and really slicing and dicing and becoming very thoughtful but also anal about it, are the ones that actually get to the answer much quicker. There's companies that, you go to the board meeting and they have like 4 hypotheses, and it's kind of a gut feel activity, and I'm like, well, what's the data say, right? And the other companies are, like it's spreadsheets and dashboards and metrics, and those are the ones that end up getting those improvements much, much quicker. So if there is anything I've seen that's worked well is, being incredibly religious about the data and
Maybe
collecting it.
a great follow-up to that would be, what is it that you do measure? And you talked a little bit about that in the introduction. So you mentioned dollar retention. Talk a little bit about the other metrics that you look at and that you follow.
Well, I mean, dollar retention is the aggregate, but I think as Byron and Roger was saying earlier, you need to track a whole bunch of things and explore different areas to figure out exactly what the cause of the churn is. And very often it's something that can surprise you. I'll give one example of the kind of company that Ping is talking about, which is LinkedIn, that does a wonderful job tracking a whole bunch of different metrics. And one thing that they found, which was a little bit surprising to them at the time that they came across it, was that a major driver of churn for them at the time was that the out-of-the-box experience, that the first user, how does that first user react to the product in the first 90 days? And do they get proficient, and do they go around recommending it to other people in the organization for their hiring solutions? And that had a disproportionate impact on whether months later that company would renew. And so that became then a major focus for the organization. One of the things LinkedIn does, it offers professional services for free or included, because they don't want to get into a nitpicky thing with people around what's a how-to question versus what's a break-fix issue. And it had a big impact on the business. So I just offer that as one illustrative example of something you may not initially think about in terms of that first user in the first few days, because that's a long way from the point at which a renewal happens. But it's an example of something that in their case had a big impact. And so, as the other folks were saying, I'd encourage you to be tracking all that data and really be analyzing on an ongoing basis and look for these maybe less obvious connections of things you can do to improve.
Yeah, it's sort of interesting you mentioned that. The first SaaS company I was involved with the IPO of was Salesforce. And what's interesting is in the early days when I asked customers what they thought of Salesforce, they all said, oh, it's intuitive and easy to use, and they just loved the company. And I always joke that it was a cult and now it's a bona fide religion, but one of the things they did well was just customer satisfaction and people loving the software and sort of more of the intangibles, maybe a little bit more difficult to measure, but certainly high in customer sat. What other things do you look at, Ping, in terms of
In addition
measuring?
to the product engagement metrics, which I think are critical, I've always been surprised with how the marketing channel and retention rates are so tightly coupled. Like where you acquire the customer and how you acquire them really impact, who that person is, how they end up behaving with the product. So, I have a company in Lookout in the mobile security space, and it's a consumer and also SMB type product for mobile security, and they acquire customers all the way from the App Store to online channels to, service provider channels, and the retention rates across all three and the other ones are completely different. And if you kind of look at churn rate on an aggregate basis, you lose all that granularity. And then therefore that impacts where you should spend your marketing dollars and how you should be more aggressive, or how you should adapt your product to certain channels, right? So, or your marketing message, right? So I think it's really understanding where your customers come from in that life cycle at the front end of the funnel is almost as important as, what happens after they interface with the customer or a customer.
Maybe to make it more real, we could give some examples of companies that have done a really good job, or conversely, a really bad job of retention. And starting, you're smiling, so I'm going to start with you because you smiled, Byron. So you don't have to name names unless it's the positive side, but talk a little bit about the good and the bad.
Sure. Well, I think one element to overlay to this is time series data, because a lot of the time those time series charts and visualizations in particular give you a lot of insights where you see behavior and churn data over time. And there's these ideas that people leg into the product in different ways, and there's value accretion points. And fundamentally, whether you're monetizing by usage directly or indirectly, usage should be a very leading indicator to value, and therefore also, as we've talked about, a leading indicator to churn. And so we see companies like Box in our portfolio, where when you get a certain amount of content in there, or you get collaborators on a folder, you get certain activities, you can project with pretty good accuracy the behavior and in that case the meaningful upsell characteristics that are going to follow. Companies like Twilio, when they've got essentially free trials through minutes and things, but when they start building certain apps and they start doing certain things, you can then see as a leading indicator to real value. Or in the case of Eloqua, it was certain enablements when they connect to certain systems and they get a certain number of campaigns with a certain amount of activity run through the system. And so you can change your behaviors accordingly. In the case of Eloqua, they did quick start programs and they changed their pricing structures, not to, in that case, shorten some time windows, but it was fundamentally stop doing monthly deals. We're willing to give on annual deals, but really quarterly was the hurdle. They want people to buy into at least running some campaigns and committing to it for a certain period of time. They would dramatically reduce the cost of some of these quick start programs to make sure that people got trained so they could be effective. Or in the case of Twilio, they'll do hackathons and give the minutes and those things so people get comfortable building their first app and understanding the API and getting some usage there. And so it can be a false sense of security or false concern if you overweight the early usage characteristics. And so for free trials or freemium models or those things, you may find that actually churn in that first month or two is quite high, and then things level out and build back up. And you just need to change your frame of reference in terms of thinking through what's the behavior that you want through there and what is actually an acquired customer. And you may find that that's really an extended part of your sales and marketing activity, and it's not until they actually partake in certain activities or upgrade to a certain level or do certain things that you really set the hook, and you should think of them then as a committed customer and hand them over to account management or do the longer term management.
Roger, what companies in your portfolio have particularly done a good job, and nameless ones that haven't done as much good?
Well, I mentioned the one before. I can't name who they are, but they had a huge amount of success by kind of standardizing around a specific set of processes and identifying what they thought the leading indicators are. Another one, and you guys may have heard some of the story earlier, is Angie's List, where they're really trying to do two things. One is just trying to consolidate all of this data around their customers in one place. They actually have a bunch of very precise activity data, NPS data, billing data, all of that, but it's in a bunch of different systems. The account managers spend 30 minutes or more just trying to get it all in one view before they actually talk to the customer. Now, God forbid the customer calls them without any warning, then they're totally unprepared and can't really be in a position to successfully address the issue. So trying to consolidate all that and then have those leading indicators to then be proactive and identify who are the service providers, the plumbers, the roofers, the electricians that are most likely to churn, and identify, what does the ideal service provider look like? What is a silhouette of an ideal service provider? And Mike Rutz, the head of sales, was talking about this earlier. How do I then work backwards to get everybody else to follow that same path? What are the 4 or 5 key steps somebody needs to take over 6 months, over a year, with the implementation, buying the specific product, getting a certain number of reviews, and if they get to that point, the likelihood of renewal is 90-some-odd%. But if I miss one of those steps along the way, the likelihood of renewal is a lot less than that. And so that's kind of the second half of the implementation. Another company that we talked to in the Gainsight diligence process also talked about the efficiency of the customer success team, and they were growing their customer base rapidly. They frankly couldn't hire customer success reps quickly enough, and it was a very manual process. It was kind of working, kind of not working, so they ended up buying Gainsight just to make the customer success reps more productive. So they could go from one rep managing roughly 25 accounts to now managing 50 accounts or 75 accounts as the customers scaled. And they used the product to manage all the activities and all workflows, and they saw a lot of value out of that.
Yeah, I'll give the negative story. It's interesting. It was a company that was a subscription basis, but it was not managed in the cloud. It was years ago, and they went from one platform version to a new one, and the customer satisfaction fell off a cliff, and they weren't really managing carefully the technology transition, and so they didn't really have happy customers at that point in time, which really brings something to mind that there was an executive who'd been at Symantec and Veritas and then went to become head of sales internationally for Salesforce years ago, and she said something to me. I asked her, well, what's the biggest difference between SaaS and the old on-premise software? And she goes, being responsible for customer satisfaction every minute of every day. So it's sort of one of those things that this company failed at that obviously Salesforce has done a good job at. Switching gears a little bit, I thought we'd change a little bit to the mathematics of it. And if you look at a company with churn, maybe we could talk about low churn, high churn, and the actual impact on the valuations you get in an exit. Maybe we'll start with you.
I feel we kind of covered it already. With Byron already spoke a lot about how and Roger as well in terms of the valuations.
But do you have any additional thoughts on?
No, not really. I think that. I think this is one point you take away. It's that it absolutely does have a massive impact. And even when I think of companies who thought they were doing well, when they focused on it and made it kind of like the central point, it again had a massive impact. It propelled their companies. The example I think of is Jive, which was a very successful company at the time. But when Sundar Pichai from Google joined the board, Google, if it were an independent SaaS company, would probably be the third biggest in the world. Google Apps is about $1 billion business growing at 50% a year. I think only Salesforce and LinkedIn are ahead of it. But when he joined the board, he brought a renewed focus at Jive on consumer-grade design in the product and on instrumenting the application to get very precise information on exactly how the app was being used. And that had a massive impact on Jive as it looked to the public markets and on growing the business. And so, I think that the evidence is in general overwhelming. I think look at that as just one example.
I think from a valuation perspective, a lot of these high growth SaaS or freemium business models will burn cash as they grow early on. And having a really good understanding of the lifetime value of a customer, which obviously churn plays is an input into, I think is really important for people to understand why you're spending the money and how you're going to recover and how the model works long term to be profitable, right? And I think that's one of the things that I always look for in valuing these companies is you have to have a path towards profitability, and you're just dialing it between growth and profitability. So I think that's one of the metrics that we try to understand, and how long and how does that picture converge over time if you're valuing the business.
Probably the simplest way to think about it is look at any analyst report of a SaaS company. And in the first paragraph of that report, they're going to track a couple of key metrics. One of the key ones is going to be churn. And that's going to have a direct relationship to what multiple that company trades at. Byron, walked through that before. And that is not news. I mean, look at any recurring revenue business. You look at Netflix, you look at any of the traditional wireless businesses. Read an analyst report, look at the top 3 or 4 metrics. It's acquisition, it's churn, it's lifetime value. And depending on the health of those numbers relative to their peer group, that's going to dictate what multiple those companies trade at.
I think that brings up a really interesting point because of the companies that I'll cover as of at least through tomorrow, since I'm retiring from William Blair at that point. What's really interesting is that the number one thing analysts look at, whether they should or shouldn't, of public companies is the revenue growth. And there's a totally direct correlation between revenue growth and valuation, more so than the ability to deliver profitability. And one of the interesting things is that the higher your churn, the lower your revenue growth is going to be over time. When we were going through a prep call, there's a company, Constant Contact, where they were growing rapidly when they went public, but the churn at 2.2 or whatever it is % per month made it that it was very, very difficult for the company to be able to continue to grow because of the high level of churn. So it's very much directly leads to a tie to the valuation, because if you can't control your churn, you can't keep the revenue growing. Maybe it's I'm sorry.
So yeah, I was just going to add to that point. On our website at bvp.com, in the cloud section, we've got a lifetime value report in our 10 laws stuff. And we've got a framework there that quantifies this. And the sort of tactical way of thinking about it, which we literally have these discussions when we're looking at SaaS deals, is what happens if you fired the sales and marketing team tomorrow? What would happen to this business? And several of the businesses we've mentioned today, including companies like Twilio and Box and LinkedIn, and many of these would grow at 30% plus without any outbound sales and marketing. They're choosing to invest more aggressively with it. But fundamentally, the engine is so powerful, the customer engagement is so strong, the virality on a user basis is so powerful that the business is growing without any outbound effort, and even faster than that in many cases with direct inbound effort. And when you look at these lifetime value models, it's all about that future cash flow stream. And in theory, you can argue about what fair multiples are, but eventually Wall Street gravitates towards future free cash flows. And that fundamentally churn and that leverage that we heard in the prior session, the operating margin from your established customers, that's the profit center of the business. And therefore, that's what Wall Street's going to value. And if you look at NetSuite, look at Workday, on our portfolio, look at Intact, who's going to be on the panel later. These are financial applications. Their cost of sales is pretty high because it takes a lot to replace that heart and lung machine. But boy, if you get in there and it's successful, you can hang a lot out of it. And if you make the customer happy, they're never going to turn you off. And so the lifetimes of these aren't measured in quarters or even, in many cases, years, but decades, as we saw through the first wave. And those are highly profitable customers over time, and thus highly profitable businesses.
I think Byron brings up a really interesting point, that one of the reasons that Workday, for example, sells at a record multiple, at least in the SaaS B2B space, is the reality that ERP systems are so horribly, horribly difficult to pull out and replace. And so they're going to be hellaciously sticky because people, as you say, it's a heart-lung machine. It really is that important to running people's businesses. Yet, going back to the email marketing, low end with Constant Contact, one of the problems that they face is that that's a relatively commoditized product, and therefore the churn rates are fairly high, and it's easy to take out. But maybe at that point, we'll open it up to the audience. I love that. I was wondering how everybody was staying on time so beautifully. And then when I got up here, I noticed there was a little clock, and it's really big that even blind Laura can read it. But I think now's the time maybe open it up to the broader audience to see if anybody has any questions for the panel. Okay, I see one way in the back.
Got a couple.
Can you speak up? It's hard to hear you. Yes, thank you. Can you hear me now? Good ad for a cellular phone.
Yeah, I wonder if the gentleman could comment in the metrics area. When we talk about churn, what typically do you use as the beginning of period to measure against? Is it annual, quarterly, monthly?
We do annual. And there's a couple different ways you can cut it. So if you think about a scenario where you have 100 customers and 10 are eligible for renewal in that period, and you lose one, you could either argue you had 1% churn, 1 out of 100, or 10% churn, 1 out of 10. And so different companies look at it different ways. We typically would look at both of those just to make sure that we're kind of tracking it a few different ways. But typically we'll monitor that on an annual basis.
Anybody have in their companies look at monthly?
Yeah,
Spend much on
I
it?
think a lot depends on the business
Yeah, of
and
course.
how they do their, what is their pricing plan and how do they charge the customers. And a lot of the consumer companies that have subscription models typically are on a monthly basis. So we look at monthly, month-on-month churn as well. Some of the enterprise one I agree with Roger is more of an annual basis.
Yeah, one of my favorite charts is the monthly CMR, committed monthly recurring revenue chart, stacked bar, where you have negative churn, you get upsells, and you get net new. But in businesses in the PaaS space in particular, transactional businesses like a Twilio or SendGrid or some of these, you'll have monthly volatility. That isn't necessarily churn, but you want to understand usage behaviors. You sometimes need to overlay seasonal dynamics to it. So there's no one method, but I would absolutely encourage to look at it outside of your renewal windows so that you can be artificially lulled into a high metric if you aren't actually including one renewal cycle in your time period. And then I'd also encourage you to look at it on a cohort basis so that you see what happens by cohort over time, because you should see improving economics and improving cohort dynamics based from attention to the area. And if you see degradation, the reverse, then it's a huge red light and all hands on deck.
Any other questions? Okay, right there.
Hi, Stacey Hartman, Healthcare First. Interested in hearing what models you've seen successful from a acquisition rep to a client success management rep from a compensation standpoint. I'm familiar with one company that was in the Bessemer portfolio that had acquisition reps and client success management folks paid commission for the first year of the customer's life cycle in order to make that transition smooth. Interested in hearing if that's a model you all have seen or what else you've done from that transition customer life cycle standpoint.
And maybe breaking that into two different questions, when is a good time to split between hunters and farmers and also paying commissions on renewals as well, which were two of the follow-up questions. So you read my mind. Very good job.
I've seen it work many different ways. I don't think there's a single answer to that. Typically, customers start just paying reps and don't break out hunters and farmers, and as they achieve scale, they have different commission structures on each of them. At ServiceNow, they just raise the quota and they include renewals in there, so that if you have, if a customer does churn, as a rep, you're in the hole, because now you've got to find a way of filling that gap. And so essentially, they bake into the quota the assumption that you will get the renewal. But I haven't really seen one way of doing it. There are lots of different models that have been successful there.
Yeah, I would echo RF's comments. I mean, it really depends also on the maturity of the company. I've found some of the earlier stage companies we work with have that function, as the same individual, because there's just not a lot of customers and there's not a lot of reps, and so that one rep closes it and they're in charge of the renewal relationship. Once they get to some point in scale, a few $1 million of recurring revenue, they tend to separate it out. And even though that may still report under the sales organization, you may have heard Bill from Marketo talking about this earlier this morning, they still stayed within the sales organization, but they're a separate group, separate comp plan, and usually there is some sort of incentive comp for renewal. It's not nearly as much as the first dollar of the acquisition revenue, but there is certainly incentive compensation on renewals. And then at some point in scale, probably when you get to the $30, $40, $50 million, it's then separated out as its own independent group, separate from the sales organization with a direct line up to the CEO.
Yeah, the other dimensions that I've seen is the complexity of the product and the initial sales. So sometimes when it's a very infrastructure piece of software that requires a lot of heavy lifting, the customer success and also the salesperson will be very tightly coupled, comp very similarly, because you need that thing to be deployed in a way that actually generates the renewal a year later. So I think that a lot of times is what I've seen. More complex, deeper product integration stuff tend to be a little more tightly coupled.
I just add, we get this question all the time, and it's the art part of the the industry, unfortunately, because there isn't one black and white answer. And we've literally got 2 separate white papers that we're working on right now where we've surveyed about 50 companies within our portfolio and looked at the public data. And so we're going to put out there the grids and some best practices with some variations. But that overlap period is the art when you get to a scale where you have some fundamental separation in the groups. And frankly, our bias is overpay early because you want people incentivized to love the customers, and that handoff point can be a bumpy one, and if they drop on the ground in between, it's much more expensive than some extra kickers for the customer-facing reps and account managers.
Any other questions? Okay, I see one right there below the bright, bright lights. Thanks. Yeah, I think so.
So we've only David Topsy, by the way. We've been selling our product for about 9 months, so we aren't really at the point where we have churn rate or recurring revenue coming in. Most of the deals, at least at this point, are for a year or longer. So wondering at what point do you guys start to look at that and say we have enough of the sample size to make it kind of an accurate number? When does it start becoming relevant to the company's growing?
I'll say it's funny. We're going to announce a deal next week that we just funded similar stage. You know, all the metrics look great. They're growing like crazy, but they're still within the first real renewal wave. And so you've got to look at all the secondary metrics, or arguably the leading metrics around usage engagement. And so we literally did primary discussions with customers, looked at metrics around application usage, as many people have talked about. That's the gift of SaaS. Whereas with shelfware before, people used to love being able to take that upfront hit on RevRec and cash flow, but fundamentally customer rebellion ultimately catches up with you. In this case, you can see what's happening with the core customers. And so we went in addition to just direct diligence calls, we looked at the stats, and you could see which customers were churn risk based on lack of engagement, the lack of getting through these milestones. And so I'd strongly encourage you to look at those things as leading indicators and then get ahead of issues while you still have 3+ months to go for the renewal window, so that you're not coming up to them with an invoice and a hard discussion, but you've at least have the benefit of trying to walk them to water before they cancel.
Yeah, churn is a rear view looking metric. So by the time you hit your churn rate, it's too late to do anything. So I really agree with Byron. Look at the data. It's amazing how if you spend just a little bit of time, you can be very predictive in terms of which customers are going to be, not just the ones that are going to churn, but also the ones you can upsell. I mean, I know we're focusing on churn, but that's the other thing that I've seen companies do really well. They intersect the customers at the right time because they figured out when they're going to be buying more of whatever, or when they're going to expand, and they get out ahead of that. And that locks them in and actually sells more. So I mean, it could work to, on the upside as well.
Yeah, many of you may have the 2x2 grid essentially of current value, future value for accounts, and account management. You segment them differently, where you have high value customers that may not have much growth potential, but they're important to you. They'll be the first ones to be swarmed and have named account managers. The high value with high potential are the golden accounts, and you should be all over those. But also the modest value but high potential accounts are the net new sales opportunities. You certainly have this group that you need to maintain, but you can treat them differently, and consciously that's a rational economic decision to tier resources, approaches, and service models.
I'd like to throw one in there that I've been thinking about, which is using channels and how that impacts the ability to keep customers, and is that a good thing to do early on and later? And do you continue to pay renewals to channel partners like NetSuite pays renewals to channel partners year after year after year forever? And unless the rates show deterioration, they don't deteriorate the compensation. So any thoughts on channel? And
I mean, it depends on the nature of the product. If it's a simple product that's easily understood, then channel's potentially an option. But I'd say that regardless of whether it's fulfilled by the channel or whether it's sold directly, that if you're early in a company's life, you'd want to be all over those early customers to understand in detail exactly what they're doing and making sure that they're having a good experience. And you wouldn't really want someone between you and the customer. Now, once you're past that initial stage, I think shortly after that, you'd need to make a decision about whether you want to emphasize channel or sell direct, because it's hard to straddle those two without conflict. And that decision really comes down to, I think, just the complexity of the sale and the product, and whether you feel it's something that can be simple enough for a channel partner who might have a broader book of business and be less capable than salespeople that you could yourself hire, whether you think they're capable of selling that.
And we have 8 more minutes and 28 seconds, so any additional questions? Come on, they're okay. Lady in the front row with the red dress and the beautiful hair.
Now I'm embarrassed.
Yeah!
So my question is about unmanaged accounts, accounts that don't have assigned account managers. For the accounts that don't, at the time, seem to have a lot of value, are expensive to service, what are some of the best practices that you've seen, perhaps in the automation or lower cost channels of supporting those accounts in a way that help to preserve the renewal or mitigate churn? And what are acceptable churn rates for unmanaged accounts?
Yeah, I'll chime in on that. It's going to be very specific to the product category. What I'd say is that some of my portfolio companies that play at the low end and sell to kind of large base of SMBs, some churn is healthy. And so it's very company specific, but not all of your customers are profitable, and you've got to go through the process to figure out what are the indications of the customers that are actually not profitable, that you actually want to fire, and getting rid of them so you can focus your resources on the ones that are actually worthwhile. And so it's a very kind of healthy but hard decision to go through, because it's counterintuitive that you'd actually want to get rid of some of your customers. That there is always going to be a certain class of customers in the kind of, the SMB market that are simply not worth holding on to. Beyond that, I think you just have to make an economic decision around, how much are you willing to invest? I mean, what is your lifetime value for this customer? And if you use the success factors data from before, can you afford to support this customer at 20%, 30% of their lifetime value? Some metric like that, and if to maintain very high operating margins with that renewing customer base. And if you can, then you can apply those. But if you can't, then they may be candidates to potentially let go over time.
Yeah, a real life example of it, NetSuite, when it went public, 50% of the new customers were leaving QuickBooks. So they were very, very low end. And then as the company went up market, they purposefully churned that low end of the business, pretty much anyone that wasn't paying them about $10,000 a year. And as they went up market, their profitability was much better because they were not profitable, those very, very low end customers. That's a real life example of a company kind of firing the very low end. And we have did anyone else?
Yeah, I guess the other thing to consider, I don't know much about your product or your business, but we have a company called Atlassian Software, which sells primarily to developers, right? And you can imagine the tail of developers that they have. And one of the things they've done very successfully to help support those people is use the community to help support them, right? So it's a very effective way of, not only getting people more endeared to the platform, but also helps you do the customer support kind of through the community. So that's something to consider in terms of managing the long tail guys that you can't dedicate, actual bodies to, but leverage the community. And there's a lot of platforms that can allow you to do that very effectively.
And I can actually give examples of 3 different answers to that from our companies that I think are all right for the businesses, but to the earlier points, it's totally situationally specific. So SendGrid, you can get a rep on the phone even if you're not a customer. Any level, any paying amount. Service is one of their front and center principles. Human contact at any point. Again, you don't have to pay them a penny. Any email question. Twilio, their view is the product should solve itself, and so they viewed calls early on as product efficiencies. And so it was all about understanding the buckets of the inbound and wrapping that up in customer support and the APIs and self-service. And they've got 150,000 developers, and their view was you can't manually solve this. You look at Eloqua or ClearSlide, their answer is we don't want to support freemium, and we don't offer freemium because we think the degree of touch and support and value here, there's a threshold for buy-in, and there's a threshold for sort of mutual commitment to get enough out of this to be worth it. And so essentially, they just have chosen not to accept unmanaged relationships. And again, for each of those business models, I think it's the right answer. And they tweak it and constantly test it, but totally different answers for totally different businesses.
And final question, second one.
Yeah, Dave, you can touch on these
Yeah, I mean, as I said before, on the enterprise side of the world, I would say our best-in-class companies are roughly 5% account churn and net negative revenue churn, so 110%, as much as 120%. On the SMB side of the world, it's usually best-in-class 15%, 20% account churn, but still roughly 115, 120 on a net revenue churn.
We have 2.5 minutes left. Anybody else want to answer that? Okay, time for one final. I lied, there's time for one more.
I'll actually just throw out just a random, unless there's a question. I don't want to. Oh, it's okay.
The fellow with, oh, okay, it's hard to see with those.
He has very nice hair also.
That's a lifetime first for me.
Yeah.
Well, given that we have a panel of venture capitalists, I'd ask a future-based question. So what's the SaaS, everything as a service business model look like 3 years from now? How's it going to change and develop?
Well,
Yeah, the biggest, I mean, just as I look, if you're looking years into the future, the thing that strikes me is just that today there's about $1 trillion of market cap in licensed software companies and about 130 billion in SaaS. And so the market's about 15% penetrated. If you look at Salesforce automation or CRM as being the most mature category with one of the strongest SaaS companies, it's still only about, I think last I saw, about 39% of revenue is SaaS. And so we're in the early days of the movement to SaaS. I mean, it's relatively underpenetrated, and you've got this $1 trillion of licensed revenue that over the next few years, it's hard to see how that stays in the long term and how that doesn't all migrate over a period of time over into SaaS, and the ecosystem just grows massively. And as that growth happens, I think the business models become more sophisticated. We get increasingly clever about how to manage things like churn and retention rate, and how to align our as vendors' interests with customers so that we can continually extract value as we deliver it to the end customer. But I think the model is working, and I think it's just set for growth and increasing sophistication over time.
Yeah, I mean, I would build on that to say, I think the technology industry is simply the first industry that's widely adopting, X as a service or subscription-based business models. The media industry is certainly going that way. The financial services industry is going that way. And I think most industries where the content is somehow delivered online will adopt the same business model over time. One of the interesting consequences of that is not only kind of this dynamic of shared fate between the vendor and the customer and all the issues we're talking about with retention and churn and stuff like that, but companies now will know more about their customers than they've ever known. And they will be able to build products faster, better, more acutely driven by the needs of their customers. And so the data that you guys are using to improve retention, reduce churn, increase upsells, that's going to be the same set of data that the product management team is going to use to drive all the incremental releases, because they're going to know exactly what the customers are doing. The engineering team is going to use that. The finance team is going to use that. So this data set around product usage will be the core asset that a lot of these companies will have going forward, and will drive a lot of workflows and a lot of activity around it, not just for customer success. That's kind of the sharp end of the spear, but a lot of other workflows and a lot of other groups within the companies will drive their activities off of this data set as well.
And that's a perfect note to end our session on.